It is a few minutes after 8, so we're going to go ahead and kick this webinar off. Good morning, everyone, and welcome to the Medical Society of Virginia webinar, Income Protection for Physicians. We're pleased to welcome Matt Brotherton from 1752 Financial. Matt started in the financial services industry after graduating from Roanoke College in 2000. He specializes in listening to clients and developing strategies that best fit their individual needs. Throughout his career, Matt has been recognized due to his accomplishments for his clients. He has been featured by a number of publications like Advisor Today, Kiplinger Magazine, and the Richmond Times-Dispatch. And I'm proud to say that 1752 Financial has been a trusted partner for the MSV Insurance Agency for over 8 years. Matt grew up in New Jersey, but settled in Richmond in 2001 with his wife and 3 children. Outside the office, you'll find him hanging out with his wife and kids, helping out at their baseball and soccer games, or at the golf course with his friends. We will begin with a short presentation from Matt about the options available to protect your income if you become injured or sick and couldn't work, and then we'll open the floor for questions. Just a reminder, this webinar will be recorded and posted on the MSV website. Additionally, please avoid using the raise hand button and instead direct all questions to the Q&A function at the bottom of your screen. With the logistics now out of the way, please welcome Matt Brotherton. Matt, take it away.
Thanks, Dustin. Appreciate that. And it certainly enjoyed working with MSV and all the members for the past 8 years. Like Dustin said, I've been in the business for about 20 years and plan to go through some information today about disability insurance, how it works, what the options are, and how we've been able to help out a lot of the physicians throughout the MSV for the last 8 years. So like I said, today, just plan on going through an overview of how disability works, what the options are, some statistics about it, what to look for when designing a policy, the tax implications, and the difference between individual coverage and group coverage. But also, like Dustin said, this is your session, so please feel free to ask questions in the Q&A bar, and we'll talk through those as well. So 30,000-foot view, disability insurance is there to protect the needs if something were to happen and you couldn't work in your daily life. Being physicians, you all are very specialized in what you do, and it's important to know that we want to make sure that the protection is there if you can't do your specialty, but you could do something else. So we think about the other insurances that we have in our lives. Most people, of course, have some type of medical insurance, homeowners insurance, and automobile insurance. Those are there to protect you against some type of health issue, some type of issue with your home, or of course your car. Now, all those insurances have an insurance premium that are paid for by your income. And of course, the income is driven by your ability to work. If you weren't able to work, of course, then you don't get paid, and those insurances go away. So one of the most important insurances to think about is your ability to earn that income or the ability to work. So disability as a whole protects you in case you aren't able to work due to an injury, sickness, or something that happens to you. The average claim for disability is 34 months. So we think about that, and that's a general public number. So not just physicians, those are your rank and file employees, CPAs, attorneys, etc. When we think about a specialist like a physician, they tend to have a longer claim because of their specialized work. And if you think about yourself for a second and put yourself in that situation and think about how much money you've saved up outside of retirement accounts, because that's where most people save their money, how long could you maintain your lifestyle if something were to happen to you? Do you have 3 years of savings set aside that you could spend and feel comfortable spending if you could not work? Now, this is some of the statistics. Disability claims, most people think this is something that happens once you hit age 50, 55, or 60, towards the end of your career. Surprisingly, 43% of the people that go on claim are under the age of 50. So we all think we have that Superman cape or Wonder Woman cape on and we're gonna make it through. We're never gonna have some type of issue that happens to us. But as you see here, a lot of the claims that do occur are under the age of 50. And of course, out of all people that work, about 17% of those folks are disabled under the age of 65. And the way Social Security disability works is it's only available from age 50 on. And I'll talk about Social Security disability and how that works here in a minute, but that's just something to think about too. It only covers you if you're 50 and older. Now, of course, disability can happen a lot of different ways. Percentage-wise of all claims, the largest percentage is due to muscle or bone disorders, and that's your arthritis, back issues, knee issues. Think about being on your feet as much as you all are throughout the day, and the wear and tear on your lower back, your upper back, your knees, especially for the surgeons out there, pushing and pulling and all the things that you have to do through a surgery. That's a lot of wear and tear on your body. Besides some type of muscle issue or bone disorder, that's where we fall into things like cancer, the illnesses that can happen unexpectedly. So claims I see with clients that do go on claim and recover benefits, a lot of times it is that unexpected situation. And I think 2020, not to hit on COVID more than we all want to talk about it, but it just showed us that unexpected things do happen to us. We want to have a plan, so in case something does happen unexpectedly, we know where that income is going to come from. And of course, a lot of people think that this only affects men or it only affects women, but the statistics are showing us that more and more women are becoming on claim. And that's due to the arthritis issues, muscle inflammation, pain that occurs to people. Obviously, this data is a few years old because they don't produce it as quick as we'd like it. But it just shows that more and more women are going on claim due to a disability. And when we think about life insurance, disability insurance, we look at the morbidity issues versus mortality issues. And obviously, women are living longer, but they tend to become disabled more and have to go on claim for disability. Now, there are two different types of disability insurance. There's short-term disability and there's long-term disability. The difference between the two is that short-term disability will cover you for a shorter window of time, 90 days or less, typically. And that policy can be designed to start on day 0, day 1, up to day 14. And then it would pay for a 3-month window of time. Typically with physicians, we don't see a lot of physicians purchasing this type of coverage. The idea behind this is more for your rank and file employee that doesn't have a lot of savings set aside. Most physicians feel that they could pay out of pocket for 3 months if they became disabled. Also, I find with clients, most physicians that see a patient today don't get reimbursed by healthcare or the patient for another 30 days, 60. Some physicians have even said 90 days before they get reimbursed. So if you became disabled yesterday, then you typically have your accounts receivable that can cover you for the first month or two, and then of course dip into savings if you have to for that last month or two. Long-term disability is there to cover you for that long term. Typically, policies are designed to cover you until you hit that Social Security retirement age of 65, 67, or even 70. So really, it's up to the client to decide how long we want the coverage to last, but that's part of the customization that we can do when designing a disability policy. What most, if not all, physicians want to have as part of their policy is a true own occupation plan. Through MSV, we've set up discounted contracts at multiple companies to make sure that your coverage is the best one for you, and it is a true own occupation plan. True own occupation means that if you can't do your specialty, but you could do something else. Maybe you could go teach. Maybe you could do some consulting work. Maybe you could start writing books. Whatever that income is that you want to generate, that's not your specialty, you will receive the benefit from the contract. Even if you're earning $1 million or $2 million a year doing something else. So own occupation is certainly the key thing that clients want as part of their contract. Another feature of the contract is what's called residual or partial disability. What that means that if you're not 100% disabled, but you lose more than 20% of your income, then the policy pays a benefit, even if you're still doing your specialty. So for example, a surgeon that can't do surgery 5 days a week, but he or she could do surgery 3 days a week. In that example, that physician would have lost about 40% of their income. In that example, the policy would pay 40% of the benefits even while they're still working. So residual or partial disability is an important feature to have as part of your contract because a lot of claims, as you can imagine, aren't full-blown claims. Another feature to consider as part of the plan is a guaranteed renewable contract. And what that means is that the insurance company can never cancel you for your coverage. You can only cancel them. So we do see a lot of clients as you age and as your savings grow, you want to cancel your contract or reduce your contract as far as how much monthly benefits that you have. And that's a common thing that you can do as a policyholder, but the insurance company can't do that to you, which is important. We want to make sure that no matter what changes with you or your health or financial situation, that they can't get rid of you. The final thing with the policy is your elimination period. And that's the amount of days that the policy won't pay until you go on claim. So meaning that if you became disabled yesterday, most contracts are set up with a 90-day elimination period. So simply that means that if you became disabled yesterday, the benefits start on day 91, so 3 months from now. The idea behind that is you have your short-term, whether you purchase that short-term health insurance plan or you have your savings set aside to cover the first 3 months of the claim. Once those 90 days are over, the insurance company kicks in and starts giving you that income stream for your plan. Some of the riders that people consider, one of them in particular is a future increase option. Where I see that used is for my newer doctors, folks that are just getting out of residency and they know that their income is only going to increase over time. So what future increase allows folks to do is purchase a plan up front and then know that as their income grows, they can increase their benefits to reflect their income. So for example, you might start with a policy that has a $10,000 a month benefit. And as your income grows, you can add up to another $10,000 of benefits without any medical questions. So it's a nice feature to know that as your income grows, you don't have to jump through any medical hoops to purchase more benefit. The next rider that people consider is an automatic increase option. And what that does is it allows you to purchase more coverage each year without any medical questions once again. Now, it's not as much benefit as the future increase option. Typically, it's a 3% cost of living adjustment. So every year, the insurance company sends you a letter and says, would you like to go from $10,000 a month to $10,300 a month of benefits? The extra cost is X, and you can decide if you want to purchase that or not. The third option is a cost of living adjustment. And what that says is that if you go on claim, the benefits would increase by 3 or 6% of inflation. And once again, that's just keeping you up to the cost of living based on inflation once you're on claim. And that's a rider. It's an option for you to consider. Typically, I see clients that are under the age of 50 add that to their policy. And if they're over the age of 50, then they don't add it. It is a cost, but when we are designing a plan, we want to make sure it fits your budget and fits your needs. The rider also can be taken off as time goes by. So let's say you started the policy at the age of 40, and by the age of 55, you had not been on claim, and you decide that that's something that we can remove. We always have the ability to go back to the insurance company and ask them to remove that rider, which would reduce your cost. And finally, a rider that some insurance companies have added recently is a student loan payment option. So obviously, a lot of physicians come out of residency fellowship with student loans, and insurance companies have made this rider available where you can have your loan payment paid if you became disabled. So instead of having to come out of monthly expenses, then the insurance company gives you an additional benefit to cover the cost of your loan as well. So once again, there's a lot of choices when designing a plan, and the amount of benefits and the way the plans have structured over the last 10 years has changed dramatically as well. Currently, insurance companies will allow you to purchase up to $20,000 a month of own occupation benefit, depending on your income. We also, through the Medical Society, have a program through Lloyd's of London, which will go up to 50,000, 60,000 of monthly income if that's a need as well. So between traditional companies and Lloyd's of London type companies, we can certainly satisfy your needs from a disability standpoint. And like I mentioned before, own occupation is so important because of your education that you've gone through, the fact that you specialize in a specific medical area. We want to make sure that you're able to get the benefit even if you're working in another occupation. Like I mentioned here on the screen, if a surgeon injures their hand but can't do surgery, they can still collect benefits even if they choose to teach, consult, write books, something different. So we want to make sure that you all know that own occupation is something that 99.9% of physicians want as part of their contract, and we can certainly implement that for the medical society members. So the difference here, I wanted to break down, when I talk to physicians, a lot of people think that the coverage through their employer is adequate. And for some folks, it is. I would say some folks that, like your rank and file employees, if you earn less than $100,000 a year, employer paid plans certainly are good. Once you hit 100,000 of income or more, typically the employer plans don't satisfy your income needs. Employer plans, whether it's a hospital or a practice, typically have a cap as far as how much coverage they provide you. Typically the cap is $5,000 or $10,000 a month. Now, if your employer is paying the premium, then the benefit is typically taxable. The reason for that is your employer is deducting the premium cost. So therefore, when you go on claim, the IRS is going to say, was the premium deducted, which it would be, and then therefore the benefit would be taxable as well. So most of the time, let's say you was a $5,000 a month benefit. In today's tax world, $5,000 if you're taxed equates to about $3,000 of take-home income, maybe less, depending on how taxes change here in the next few years. Now, if you pay the premium, then the benefit is 100% tax-free. So generally, if it's deducted as an expense, it's taxable as income. It's kind of an easy way to think about it. What I do see a lot of times, what people do is they'll have both. They'll have the employer plan because it's just part of your contract. It's part of what your employer gives you or the hospital gives you. And then certainly it's very common to layer individual coverage on top to offset that difference. So for example, if you made $300,000, you certainly are going to take the first $5,000 of taxable benefit, and then we would layer on an individual plan on top to get you closer to your take-home income. Typically disability insurance companies, and we work with all 8 companies here in Virginia and throughout the East Coast, will cover you for about 65% of your income, sometimes up to 80%, especially when we use the Lloyd's of London type contracts. So we want to make sure that your take-home income is covered by the insurance. So why people consider their own individual plans? Of course, it gives you a lot of flexibility, allows you to maintain the type of coverage that you need. Also, it's portable. So let's say you started at Bon Secours and then you went to HCA and then you went to VCU, the policy that you purchased stays with you. Whether or not the hospital or the employer offers any type of group coverage really doesn't matter to you because you know that you have a policy that'll go with you, whether you move from one hospital or one practice to another, or from one state to another as well. So your individual coverage typically is going to be also better rate plan because of course it's based upon your own individual health, not the health of the group. And you can customize it. Like I mentioned before, we want to customize your benefits based upon your needs and not the group's needs. So when working with the physicians, and as many as I do, everyone's different. Everyone has a different philosophy as far as the benefits, as far as their need goes. Some clients want to insure for the most money they can because they spend every nickel they make. A lot of clients also then say, all right, here's how much I spend per month. And then we insure based upon that expense. And then, like I mentioned before, over time, the amount of coverage that you have can change. We can reduce it, we can change it. It is customized over time as well. So in summary, the obviously through Medical Society, I've worked with you all for about 8 years now. We've set up discounted rates at a number of different insurance companies. In general, there's 8 different insurance companies that offer own specialty plans. I work with all of them, so I help shop the market for you to make sure you're getting the best program. We customize the plan based on your needs, add the appropriate riders that are important to you all. And then at that point, show you specific costs. Typically, premiums run about 2% of the income, round numbers, sometimes less, sometimes more. But it's an affordable benefit to ensure your greatest asset, which is your ability to make money. So I really appreciate the time today. Obviously, welcome any questions, things that I can help you with. I'm certainly a resource. As you probably saw on the screen, I'm happy to talk via email, phone, text, whatever is the best way to get in touch with you all. I guess now we'll open up to questions and see if there's any specific information I can help you with.
Dustin, I think you're muted.
Oh, can you hear me now? Gotta love technology. So anyway, I was just saying, great job. And I think you covered a lot. But one really quick question that came up on the student loan rider. Is that just for students and residents if they purchase the policy? Can they purchase it after? Once they start practicing, and then what do you typically see when someone that, or who would you kind of think would be the best candidate for, a student loan rider?
Good question. So the student loan rider typically is purchased after residency or fellowship. So if somebody comes out and they have hypothetically $100,000 of student debt, and that's a concern for them, then we would add that rider to the policy. And the rider may pay, $2,500 a month to that student loan. So they might have a $10,000 a month benefit, and then an additional $2,500 would be paid to them to cover that student loan cost. And then if 5 years goes by, 10 years goes by, and the student loan has been paid off, then we'd simply take that rider off the contract. So it's a nice benefit. I guess where I see people use it is if they're concerned with the student loan price or the student loan balance that they have up front, and they're just getting out of residency and they just got their first contract, then I do see folks add that rider. If they're a more established physician that's, let's say 40 plus years old, then they usually don't add that rider.
Excellent, thank you. Any other questions? I do have one more, so put you on the spot. Yeah. We do have physicians that are solo, or maybe they're in a small practice. Employer-sponsored disability may or may not be an option. As we know that could be difficult to get employer-sponsored group DI. What is your suggestion on someone who may be a small business owner? Should they look at employer-sponsored DI? Should they not, and then just get individual disability? What are some of the strategies that you have for those situations?
Yeah, so a good question. So typically for your solo physicians, what I see folks do is they'll purchase an individual policy first, and then look to add on the additional group. The reason for that is your individual coverage is more customized and more specific to their needs and own occupation definitions. And then adding the group can be beneficial, especially if they have a couple staff, to give them that additional benefit. So certainly, MSV works, as you mostly know, of course, with One Digital, and it's a great combination of using individual coverage with the group benefits as well.
Excellent. Very good. Well, if there's not any more questions, I want to formally thank you, Matt, for joining us and speaking with the group today. And then be on the lookout for the link to today's webinar. And I hope everyone has a wonderful Friday.
Thank you. I appreciate the opportunity to talk to you all, and keep me posted if you have any follow-up questions.
Very good. Thanks so much.
Thank you. Bye-bye.
Bye.